The key intuitive distinction is that arbitrage is a force of market efficiency, while dumping is a strategic market distortion. Arbitrage, the market corrector. Arbitrage is the practice of simultaneously buying a product in a market where its price is low and selling it in another market where its price is high, to make a risk-free profit from the price differential. This is a reactive and opportunistic action. Intuitive purpose. The goal of arbitrage is to exploit an existing price inefficiency. The act of arbitraging itself helps to eliminate that very inefficiency. By buying in the low-price market, demand increases, pushing the price up. By selling in the high-price market, supply increases, pushing the price down. The result is that prices in the two markets converge toward a single, more efficient price. This is a real-world application of the law of one price. Example: a stock trader notices that shares of company A are trading for $50 on the New York Stock Exchange but for the equivalent of $50.50 on the London Stock Exchange. The trader instantly buys the shares in New York and sells them in London, making a profit of 50 cents per share, minus transaction costs, with virtually no risk. This action helps to align the prices on both exchanges. Interrelated concepts. Arbitrage is generally seen as a positive force in economics that promotes market efficiency, liquidity, and fair pricing. It is a fundamental concept in finance and international trade, especially in currency and commodity markets. Dumping, the market distorter. Dumping is a strategic, and often predatory, business practice where a company exports a product to a foreign market at a price lower than its domestic price, or even below its cost of production. Intuitive purpose. The goal of dumping is not to make a risk-free profit from existing prices, but to aggressively gain market share or eliminate competitors in a foreign market. A firm might accept losses initially to drive out rival companies, with the ultimate aim of establishing a monopoly or dominant position that allows it to raise prices later. It is a proactive and strategic action designed to manipulate market dynamics. Example: a country's steel manufacturer, with support from its government, sells steel in a foreign market for less than it costs to produce. Local steel companies in that foreign market cannot compete with such low prices, are forced out of business, and the foreign firm captures the entire market. Interrelated concepts. Dumping is widely considered an unfair trade practice. International trade organizations like the World Trade Organization, WTO, permit countries to take action against dumping through the use of anti-dumping duties, which are tariffs imposed on the dumped goods to bring their price closer to a fair market value. Summary of key differences. Feature: arbitrage. Dumping. Primary objective: to make a risk-free profit by exploiting existing price differences. To gain market share, drive out competitors, or dispose of surplus production. Nature of action. Reactive. A response to an existing market inefficiency. Strategic. A proactive business practice to manipulate a market. Effect on market. Promotes market efficiency and price convergence. Distorts competition and can harm domestic industries. Perception and legality. Generally considered a legal and positive force for market efficiency. Considered an unfair trade practice, regulated by international trade laws, and can trigger punitive tariffs.